we will talk about how to save taxes on your passive income.
If you are a salaried person in the 30% tax slab, it's very frustrating that almost a 1/3 of your interest income and dividends is just gone by default.
The common belief is that tax planning is either illegal jugaad or something reserved only for big business owners.
But here is the reality. There is an extra taxpayer in your family which you have not really explored. Under Section 2, Subclause 31 of the Income Tax Act, Hindu Undivided Family or HUF is considered as a separate legal person with its own PAN card and most importantly, its own separate tax slab starting from zero. We are NISM certified investment advisor
And research analyst, and we use this exact legal structure to optimize our finances as a salaried couple. In this video, we will show you 3 practical ways to save lakhs in tax every single year. We will help you build the inflation shield for your emergency fund, help you escape the success trap of surcharges, and protect your rental legacy.
Now, to implement these strategies, you need an already set up HUF which is funded. If you are starting from scratch and need to know about the eligibility, the step-by-step process of creating an HUF and how to fund it, we have created a dedicated deep dive video on this, which is linked in the description.
For this video, we are assuming your HUF is ready and we are jumping straight into the high value strategies.
The first step of financial planning is building a shield, your emergency fund, which is almost 6 to 12 months of your monthly expenses sitting in FDs or liquid funds. The problem is that most people don't realize that their shield is leaking. If you have set aside 20 lakh rupees in emergency fund, which is earning 7% annual interest, you are earning interest of 1,40,000 rupees per year. As an individual in 30% tax slab, you are paying 43,680 rupees every year in taxes on this interest income. In an HUF, under the new tax regime, you have a basic exemption limit of 4 lakh rupees. Your 1.4 lakh interest income is well within that threshold and your taxes are zero. This is vital because taxes eat into your real growth. If you have an inflation of 6% and you are paying 30% tax on your 7% FD, you are actually losing money. By saving this tax, you stop the silent leak, and it also ensures that you don't have to keep topping up the funds from your salary to keep up pace with inflation. Once your emergency fund is safe, you can start investing in growth assets in a mix of equity and debt instruments. But there is a hidden success trap known as surcharge. If your total income, including those stock market gains and interest income, crosses the threshold of 50 lakh rupees, the government levies a surcharge of 10% on the total tax bill. Most people, while making the investment, ignore the 10% surcharge because they are not yet in the 50 lakh tax bracket. But for most of us, this isn't just an if, but when. As you approach retirement, you will naturally move your investments from growth-oriented assets to income-generating assets to fund your lifestyle. Or you might simply decide to book your long-term equity gains or real estate profits when your career is at its peak. When these two things happen simultaneously, your highest salary bracket and your biggest investment exit, it creates a tax collision. They combine together to push your income over that 50 lakh threshold. Suddenly, you aren't paying taxes on your gains, you also owe 10% surcharge on your total tax bill as well. Let's understand the impact. Imagine you have a 45 lakh rupees of annual salary and you have built a portfolio over a period of time that generates 8 lakh in passive income through dividends and debt mutual fund gains. You also have a 50 lakh rupees equity portfolio which has doubled over the past 5 to 7 years. This year, you decided to liquidate your equity portfolio. With 25 lakh rupees of long-term capital gains, your total income now gets pushed to 78 lakh rupees. Without HUF, you are in deep surcharge zone. You don't just pay 12.5% on equity gains or 30% on debt mutual fund gains. You also pay a surcharge of 10% on the tax liability on your entire 78 lakh rupees income. Your total tax bill will be roughly 16.8 lakhs. With HUF, you shift the entire 33 lakhs of passive income under the HUF account. Your individual income stays at 45 lakhs, the HUF income stays at 33 lakh. Both are below the 50 lakh thresholds and there is no surcharge on both the accounts. By routing your portfolio through HUF, you are able to save 3.7 lakhs in taxes in a single year just because their assets were held in a different name. By investing your investments through HUF, you are essentially locking in a surcharge-free future. The HUF acts like a time capsule. It protects your future wealth from tax consequences on your future success. The next major source of passive income for Indians is rental income. If you have ancestral properties that are already generating rent, you are in a great position to optimize your taxes. Since the ancestral property naturally belongs to the HUF, you can directly move the rental income under the HUF. The HUF has its own tax slab. You are essentially shifting the rent from your higher 30% tax bracket to HUF's low or even zero tax slab. However, for those of you who have self-acquired property via your own money, there is a massive trap. You cannot simply transfer it to an HUF. If you do, the tax department will trigger section 64 subclause 2, which clubs the entire rental income back to the individual, making this whole exercise pointless. But the good news is you can use what we call a subletting strategy. Instead of permanent property transfer, the HUF leases the property from you and then sublets it to the actual tenant at a slight premium. In this way, the HUF earns a profit on that extra premium as business income, and the property stays safely under your name. This allows you to capture a portion of the rental income under the HUF's tax slab. This will also help you build your HUF corpus without ever triggering the clubbing trap. Now, because there are specific legal steps involved to structure this whole mechanism, we have created a detailed 2-part video on this on our YouTube channel. You can find the link in the description below so that you are setting it up in the right way.
Earning passive income is important, but tax optimization brings the required efficiency to reach your desired goals. Every rupee you lose to avoidable taxes is a rupee that isn't compounding for your future. By optimizing, you aren't just saving money, you are accelerating your journey to financial freedom. The essence is simple. Don't let a silent leak of taxes drain your hard work. Setting up an HUF, opening the bank account and setting up a demat account is a one-time task, but it unlocks lifelong benefit for your entire family.
Remember, the goal isn't just to make sure that the money is working for you. It is to make sure that it is working at 100% capacity. We'll see you in the next one.
Bye.
Bye.